In 2018, I invested in a company called Vakrangi Limited, and on paper, it looked like the perfect investment. It had stable margins, its sales were increasing, profits were increasing, it had cash on its balance sheet, and over the last few years, it was even a multi-bagger. So when the stock dropped by more than 30-40% in a couple months, I thought, what's happening? This could be a great investment. But when I consulted my mentor at the time, he simply asked one question: what is the business model of this company? And I couldn't really understand. I tried to explain it to him, sir, the business model is very simple. What they do is they run on a franchisee model. They give out franchises of little shops, right, or kiosks from in rural and semi-urban areas where people can go and open their bank accounts. They can pay their phone bills. They can buy insurance, all of that. But he kept asking me the same question: what is their business model, right? And so I tried to do a little bit more research, and I actually decided to visit a couple of these kiosks. And when I visited them, one of the first locations I decided to visit, which was showing up on Google, it had a phone number, it had everything, but when I visited, there was basically nothing over there, right? So I tried to dig a little bit more, and I found out that this company had a history of wrongdoing, in the sense they had wrongfully shown expenses of more than 100 crores of buying a software, but they hadn't actually bought a software. So a lot of these instances of little frauds, they'd been indicted by SEBI in the past. So there are all these little instances of this not being a great investment, but it was almost like I had already made up my mind. And even though I had all this evidence that was contradicting my view, I simply did not change my opinion. And I ended up investing in the company, and within a month or two, my investment was down by more than 30-40%. Luckily, it was a relatively small part of my portfolio, so I didn't lose a lot of money. But this incident really taught me, it made me thinking, it's like, how is it that when I had so many obvious glaring facts in front of me that were saying that this is not this is not a great company, it's not run by very ethical people, they're probably not very shareholder friendly, why did I still go and invest in the company? And over the course of asking this question, I realized that there's a behavioral bias called confirmation bias. And confirmation bias is the tendency to look for look for information, look for evidence that already confirms your already held belief or opinion. And as investors, I think the confirmation bias can be a really dangerous thing. And I would strongly recommend that if you are an investor, whenever you've made up a mind about something, always try to look for evidence that contradicts your opinions, because that can give you a lot of information, important information, and can save you from losing a lot of money. Right? With that said, I want to get started with the actual analysis of IIFL Finance in this video.
We're going to break down the analysis into three major parts. Part number one, we'll discuss the business segments, basically the types of loans IIFL provides. Number two, we'll understand the risk. Number three, we'll discuss valuations. So let's dive in. Now, the best way to understand a bank or an NBFC is to break down its business into two parts. The liability side, which is where the NBFC is borrowing money itself at a certain interest rate from banks, from investors, from other financial institutions, and then it's lending the same money at a higher interest rate on the asset side, which is basically consumers, whether it's home loans, gold loans, whatever it may be, right? So we're going to start off with the asset side. And as you can see from the graph over here, 80% of the loan portfolio of IIFL Finance consists of home loans, gold loans, and microfinance, right? The remaining part, the non-core part, consists of loan against property, construction and real estate finance, loan against shares, etc., etc. Now, over the 5 years that have just passed, last 5 years, home loans have more than doubled, gold loans have increased more than 4 times, and microfinance has increased more than 10 times, right? And interestingly, if you look at this graph right now, you'll see that the point to be noted here is that the business strategy, or at least the focus, has completely changed over the last 5 years, right? Now, this characteristic of quickly changing strategy, quickly entering and exiting or slowing down segments is a pretty common behavioral or common feature in IIFL Finance's business. And quickly being able to start lending in a new segment and then scaling it up fast has both advantages and disadvantages, which we'll discuss more about in the part 2 of this analysis, which is understanding risk. For now, let's focus on the home loan segment of IIFL Finance's business. Home loan portfolio of IIFL Finance has grown, or it has actually more than doubled, which means that it has grown at a CAGR of around 16%. If you compare that with the CAGR of the home loans on a system-wide basis, that growth rate year on year is around 12%, right? So this means that IIFL Finance home loan segment has grown faster, which means that it has actually taken market share away from other players, right? And the home loan portfolio itself, if we break it down, is made up of two parts or maybe even three parts, right? Housing loans, affordable housing loans, and loan against property, right? And the most interesting of these is the affordable housing. The reason is that the affordable housing segment, for obvious reasons, is a very fast growing industry with a large headroom for growth. The central government's Pradhan Mantri Awas Yojana, combined with this huge gap between affordable housing needs and the actual inventory that is there on the ground, it gives a huge room for growth. And according to their investor presentation of December 2022, they're saying that according to them, affordable housing is expected to grow from 9 trillion to 13 trillion by 2025, right? If you break down affordable housing also into different segments, as you can see from the chart on your screen, there'll be different segments, right? Where there is economically weaker section, the LIG1, lower income group 1, MIG1, MIG2, and all of that is dependent on what is the household income of the borrower, and accordingly what is the maximum area allowed, and also what kind of subsidy they are allowed, right? And my estimate is that IIFL Finance as a company is actually catering to the MIG1 and MIG2 type of borrower, right? If we transition and talk about the type of employment, so what is the employment status of the borrowers that are taking loans from IIFL Finance? I think the target group focus is on salaried segment, because as we can see from this chart, 60% of the loan portfolio is given to salaried segment. And by the way, this has changed, actually quite the opposite way, because it was 58-42 in favor of self-employed segment in 2018. And it has actually been observed with a lot of housing finance, not a lot, but the few that have gone wrong, it has been observed that they were very heavily into the self-employed segment, and things went, wrong, partly because of that. Right. Again, moving on to portfolio yields, if you look at this graph, compared to some of the top affordable housing finance companies, IIFL's portfolio yields are amongst the lowest, right? And before we interpret what that means, let's be very clear that yields, the yield for other players that are shown here. And by the way, yields simply mean ki kitna interest rate they are able to earn on the loans they are giving, right? So if you look at these players, Awas Financiers, Aptus Value Housing, Home First, their yields and the yields of IIFL Finance's home loan business are not necessarily directly comparable. और उसका reason ये है because all these players are mostly only in affordable housing, right? So naturally the yields are going to be higher because it's a more sensitive or weaker section of the society. Whereas IIFL Finance का जो कितना percentage normal housing में है, कितना percentage is in affordable housing is currently not really at least 100% known, right? Still, all the other things constant, a lower yield should ideally equate to lower risk, which should reflect in lower NPAs. But interestingly and surprisingly to me, it seems that that is not the case for IIFL. Because if you look at the GNPA ratio or gross NPA ratio, we can see that the NPA ratios are towards the higher side on a comparable basis to all these affordable housing players, right? Which is surprising because you would expect that affordable housing, higher rates they're lending it, chances are that IIFL Finance's NPA should be much, much lower, but that's not the case. And it is not even about the NPA being higher, but a bigger question is that there is actually a significant jump between FY 21 and 22 from 1.5% GNPA to 2.6%, right? Which is quite a large jump. According to the management, this increase in NPA was a result of RBI making some changes on how NPAs must be classified, right? Just to give you some context, if an EMI is unpaid for more than 90 days, the loan account becomes an NPA. Another way to think about it, or another interpretation, is that when three EMIs are unpaid, right, meaning assuming that every 30 days, every month an EMI is due 30, 60, 90, so three EMIs are unpaid, that's when an account becomes NPA. So a lot of these NBFCs, what they were doing was, even if a customer paid just one EMI out of the three outstanding ones, they would reclassify the account as a standard account, meaning a non-NPA account. But in reality, that wasn't true, because you already have two EMIs that have not been paid, right? So they played a little bit with the interpretation of these rules. And when RBI found out that some NBFCs were doing this, they released a circular on 12th November 2022, said that this is not the right way and this is how you should do it. So they provided guidelines on how to do it correctly, right? And as a result of this, the NPA ratios of a few NBFCs went up, right? Now, first of all, it's a little bit sneaky, right? They played around with a little bit with the interpretation of the NPA classification norms. Secondly, even if you compare the increase in NPA because of the RBI circular of IIFL Finance with some of the other players in the industry, for example, Awas financiers or Home First, the quantum of increase because of the circular is not as big for these companies, versus IIFL Finance, right? So that's the second thing. Thirdly, even if you look at it on an absolute basis for a segment which is considered to be one of the safest, right, home loan segment, right, having an NPAs of 2.6% seems to be a little bit on the higher side. Now, the thing is, how would we interpret it? Well, I wouldn't lose sleep over this issue, but it is something to keep note of, right? On the positive side, the growth prospects of the home loan segment are beyond excellent, because housing as a segment in and of itself is a relatively high growth segment. And even within that, the affordable housing segment, where the company is focusing, right, is, it's a high growth segment, right? On top of that, if you look at the number of branches the company has added over the last 2 years alone, it has added around 225 new branches in just 2 years, right? Increasing its total branches from 125 in FY21 to 349 in FY23 so far, right? So this means they've added more branches in just 2 years than they have in the last 15-17 years of existence. So on the growth front, things look pretty interesting. Now let's talk about the second key business segment for IIFL Finance, which is gold loans, and it makes up 32% of the total assets under management. Now, without a doubt, gold is an Indian obsession, and as Indians, there is a lot of sentimental and cultural value attached to the metal. In fact, we are the second largest importer of gold in the world after Switzerland, and last year alone, we imported gold worth $34 billion, right? And more than 75% of Indian households own gold, which means that in times of stress, not only do we end up buying more gold because it's a safe asset to park cash, at least that's the perception, and secondly, it also serves as a collateral for short-term loans. Now, the general perception around gold loans is that they are availed in times of crisis, so they're kind of like distressed loans, and that's kind of true. But according to Digant Haria, he's a banking analyst with more than 10 years of experience in the industry. He says that gold loans are mostly used for taking short-term business loans and serve as a poor man's credit card, right? So that was a very interesting take on how gold loans work. And if you actually look at how the gold loan business of IIFL Finance specifically has grown, it's increased from 4,000 crores in 2018 to around 18,000 crores in 2023. And gold loan AUM, if you compare two of the most well-established NBFCs in the gold finance space, Muthoot and Manappuram Finance, if you check the yields, right, how much they're earning on these loans, the yields on IIFL are much lower or somewhat lower, reflecting that they are catering to a relatively low risk category of customer. But if you look more closely at the graph, you'll notice a trend in the yields over the last 3 years. So from a peak in 2020, what we're seeing is we're seeing a reduction in yields for all three players until 2022. And then in the last 9 months, right, until December 2022, we're seeing kind of like a reversal in the trend to some extent. Now, there are a couple of reasons for this. The first reason is that interest rates were reduced to the lowest they have ever been in order to fight the COVID induced stress on the Indian economy, right? Secondly, because during times of crisis, the demand for gold increases, the prices of gold also increase during this period. And because more than 75% of Indian households actually hold gold and they were going through tough times, the demand for gold loans massively increased, right? Because of this increase in demand for gold loans, the competition also increased, and normally players such as banks and fintechs that were normally not so focused on gold loans all of a sudden increased their focus. And because of this competition, the yields, the interest rates that were being charged came lower and lower. And fourthly, and this is a big one, RBI allowed the banks, only banks, to increase their LTV on gold loans from 75% to 95%. Now, what is LTV? So LTV is basically loan to value. For every 100 rupees worth of loans, how much worth of gold, how much loan can a customer get? So there's a limit that RBI sets, and previously for banks there was 75, and across the spectrum for every player who's doing gold financing it's 75. But during this period, RBI increased that to 90% only for banks, which means banks, you could go to banks and get more loan for the same amount of gold that you have, and naturally customers gravitated towards loans, right? So combine all of these four factors, you had a lot of competition coming in and yields continued to dip for 2 years. But recently, in the last 9 months, we are seeing a little bit of a reversal of that trend. And I think there are two reasons why this reversal has happened. First of all, the LTV of 90% is no longer allowed. It was only allowed for 1 year. Secondly, the interest rates overall in the system have also increased. As you must be aware, RBI has been raising interest rates to fight inflation. Now, not surprisingly, during this whole episode, banks as a whole stole a lot of market share from NBFCs and gold loan companies, and the loans provided against gold jewelry by banks in September 2022 were around 47,000 crores, and by September 2022 they had increased to 80,000 crores. Very massive growth. Now coming to the question of NPAs, and unlike in the case of home loans, the gold finance business has actually the lowest NPAs amongst the three NBFCs we're comparing. But even on an absolute basis, for an NBFC that charges 18%, NPAs of 0.9% even in the worst of times are a great achievement. Now obviously gold loans fundamentally are kind of lower risk, probably one of the lowest risk loans you can provide, but still I think it's a great achievement. When it comes to the question of growth going forward for the loan finance segment of IIFL Finance, I'm a little bit cautiously optimistic because first of all, the competitive intensity has increased. As we discussed, a lot of customers for gold finance went to banks for the first time, and a part of those customers have not returned. If this trend were to continue, the gold finance business would be impacted depending on the competitive intensity. Secondly, gold finance industry is somewhat dependent on the price of gold, because as prices increase, the incentive for people to give that gold as collateral increases as well. And in the words of my friend Ishmohit Arora from ISOIC, gold is a kind of shallow cyclical industry, right? So that's something we need to keep in mind. Now, if you look at the gold loan branches for IIFL Finance, in FY21, they had around 1,1900 branches, and by December 2023, they've increased that to nearly 2,600 branches. So they've set up nearly 700, 800 new branches over the last 2 years. So there's a lot of unutilized firepower waiting to actually, start working in their favor. And if the environment works, if they're able to execute on the strategy, I think the growth could be great. But again, I'm a little bit cautiously optimistic. I think this is one of those situations where you have to be very aware and monitor the situation quarter by quarter. The next segment we're going to discuss is the microfinance segment, and this makes up around 14% of the total assets under management. Now, microfinance works on a very interesting concept called the JLG, or joint liability groups. As the word suggests, groups are formed of women up to 10 to 12 women in a group, and the whole idea is that loans are provided on a group basis. And because these loans are provided to the bottom of the pyramid with household incomes up to 3 lakhs, they don't really have any physical assets to provide as collateral. So, interestingly, in this case, the collateral they're really giving is social collateral. And the way it works is that these women are supposed to meet on a weekly basis and make repayments. And if for whatever reason one woman is unable to pay, the rest of the women in the group are liable to pay her share. And so this creates a incentive for everybody to keep paying, because if you don't pay for a long time, obviously other women are paying for you, and that kind of opens you up for social ostracism. So basically you will be socially segregated for that behavior. And secondly, if you continue to not pay, then you also are removed from the group, which means that your next best option now is to raise money from local money lenders, which are going to be charging rates that are multiple times of what these NBFCs or microfinance institutions are charging, right? So in that way, I think it's a very ingenious model. But every 3-4 years, there are instances when large-scale incidents happen that impact the entire group. In such situations, defaulting as a group becomes more advantageous, at least for the time being, while the crisis persists, than say have only 2 or 3 women paying up regularly. And that's why during a crisis, when NPAs come, they come fast and sharp, right? And as an industry, as far as the total number of borrowers are concerned, there are 7 crore borrowers who avail microfinance loans, and the overall industry, the size of the industry is 3.1 lakh crores. There are 5 types of players in the microfinance sector: the NBFC, MFIs, the banks, the small finance banks, the NBFCs, and the not-for-profits. And if we look at NPAs, at least on a system-wide basis, banks do a terrible job at assessing risk. As you can see from the chart, between June 2022 and September 2022, banks had probably one of the highest NPAs amongst the entire 5 different types of players, followed by small finance banks, which is a bit surprising because these guys were supposedly the best NBFCs in the microfinance segment, and these are the guys who asked for and then got licenses to convert into small finance banks. NBFCs, surprisingly or not surprisingly, are the best at risk management, and this is the segment our company IIFL Finance currently lies in. However, IIFL Finance's MFI segment seems to have a relatively higher NPAs than the average NBFC NPAs. Now, although the data we have for IIFL Finance is the 9 months data of this financial year up to December 2022, and the data in the graph is obviously from June 2022, a quarterly data. So maybe it's not the best comparison, but if we are comparing these numbers, then the NPAs for IIFL Finance don't look great on a comparative basis. Another reason for this discrepancy could be that these NBFCs may be charging different interest rates, might be targeting different segments within the microfinance. I mean, there could be a bunch of reasons, but maybe, just maybe, it might be a reflection once again of the aggressiveness of the company. Because if you look at the assets under management, they've grown rapidly. They've almost increased 10 times between 2018 and December 2022. And because no stock analysis is complete without understanding the risk associated with investing in the company, now let's jump on to the risk analysis part. So the number one risk that I see personally with the company is that the aggressive behavior they've shown in the past of aggressively entering particular loan segments and then exiting particular loan segments when they don't go well. So this aggressive behavior has advantages, has disadvantages. The advantage is that obviously whenever there is an opportunity, they're able to capture that opportunity. The disadvantage is when you move too fast and that loan segment is new for the company, you can end up with a lot of NPAs. And because any loan segment requires a significant amount of time to actually do it well, you can end up with NPAs because you don't have that expertise, or you haven't taken the time slowly to build that expertise. Now, to give you an example, between FY13 and 2017, the commercial vehicle segment was what they entered into aggressively. From 1%, it increased to, I believe, 14 to 17% by 2017. And then, the cycle slowed down. And then all of a sudden, you had NPAs increasing very rapidly. And they eventually ended up selling that commercial vehicle finance business in 2019 to Indostar Capital, right? So you've got to be aware of this behavior, and it's interesting to see how that will play out in the future, because already microfinance section or the segment is one that might be prone to this error again. Unless the company has been smart and learned from their mistakes and all of that. The second key risk is the ability to maintain a certain asset quality, and the management is saying they want to maintain it at 2% gross non-performing assets and 1% net NPA. And it'll be interesting to see whether they'll be able to achieve this, because in the past, yes, while for a long period they have been in that range, there are instances when the cycle turns, when the asset quality deteriorates. And also the impact of the RBI circular is something that kind of made me think, that if it took the RBI to kind of correct how they were classifying NPAs, and the jump was significantly larger than at least some of the other players. It's something to keep note of, and it's something to keep monitoring as we go along. The third key risk that we want to talk about is obviously understanding that growth is a double-edged sword, right? And when things are going good, and because it's a cyclical business, you can see profit increasing, ROEs expanding, all of that. But when the cycle turns, you hit this phase where there is a double whammy, because your loan growth is not growing as fast, which means your denominator is growing slowly. At the same time, your NPAs, which is your numerator, which is growing rapidly. So, that can put the company into a lot of a problematic situation. And another thing to note is that there have been many finance companies in the past who've grown rapidly. You talk about Repco Home Finance, you talk about Piramal, you talk about PNB Housing, you talk about Federal Bank, which went up 5 times in 7 years and then for 5 years didn't give any returns. You talk about Yes Bank, which grew very fast and finally imploded. So there are a lot of instances of companies that have grown very fast and then not being able to handle that growth. So ideally, we don't want to see IIFL Finance, falling into that category. And finally, the fourth risk is the risk of execution. Now, I believe that at least as far as the management quality is concerned, I think execution is not a risk as such, but it'll be interesting to see, because they are probably the only NBFC that I know who've rapidly expanded their capacity. So gold loan branches have increased, 700 new branches, around 250, 225 new home loan branches. They've hired more than 6,000 employees in the last 1.5 years alone, 1.5, 2 years. And so it'll be interesting to see how they're able to use this unutilized capacity, and whether and how long it'll take for this capacity to get observed. Because bear in mind, meanwhile, because of this expansion, the cost to income ratio also kind of has increased, right? So these are some of the risks that we want to keep in mind. And with that, let's jump into the valuation part of the analysis. So in the valuation section, I'm going to talk about 3 different types of valuation methods I've used. Each of them have their advantages and their disadvantages, and we'll discuss them as we go along. The first one is called the earnings yield valuation. At least that's the name that I'm using just for, just to call it some name. And the way it works is you want to equate the ROE of the company you're investing in. You want to relate that somehow to the FD rate that you're earning, right? And so if the ROE is 15.4% and the price to book value is nearly 2 times, it means that per 1 unit of book value, currently as the price to book value stands, you're earning a yield of 7.9% if you invest in the company, right? So that means that, that's your starting position, 7.9%. Now the difference between this 7.9% and an FD I mean, there are a lot of differences, but one of the primary differences is that the FD doesn't necessarily grow. And even if it does grow, it only grows in the context that if you're earning a 6%, if you reinvest the entire 6%, assuming no taxes, it can only grow at a 6% rate, right? Whereas this FD can grow at much faster rates depending on the different scenarios that can play out. So in this context, we've taken three different scenarios: the bear scenario, the base, and the bull. Bear would be 15% growth, base is 20%, and the bull would be 25%. And we want to compare how this 7.9% grows over the next 3 years, and check in 2026 what is that yield that we'll end up earning if we were to own such an FD like kind of instrument, right? If the bear case plays out, which means 15% growth will happen year on year, CAGR, then the earning yields at the end of FY26 will be 12.1%. Not great, given that it's not exactly an FD, it is a company with its own risks involved. So 12.5% doesn't really cut my, I won't really be too excited about a 12%, right? Especially because I'm investing in an equity, right? Which means stocks, which means companies. If the base scenario plays out at 20% growth, it means I'll end up with a 13.65% FD kind of earning return at the end of 26. And if the bull scenario plays out, which means the company really has to go grow at 25%, I'll end up with a 15.42. This is where things begin to look at least reasonably exciting. It also kind of means that if your return threshold is 15%, ideally it should be at least 18, 19, 20%. But let's assume that is your minimum threshold. Then in 3 years you will begin to kind of make that return. The disadvantage of this method is, first of all, we're assuming that this 7.9% will remain 7.9%, it won't decrease. So unlike an FD, which will remain a 7%, this is a lot more fluctuating kind of instrument. And given that ROE in the past, or at least the recent past, has fluctuated quite a lot, it's a cyclical business, we don't really know whether ROE will remain at these relatively impressive levels, right? So that's the disadvantage of this method. Now we'll move on to the second method where we'll be using the book value as a starting point for valuation. The second type of valuation is a price to book based valuation, and our starting point is our book value per share on a consolidated basis, which is 230 rupees per share, right? Again, we're going to assume three different scenarios: bear case 15% growth, base case 20% growth, and bull case 25% growth. Now, if we compound over the next 3 years, if book value is able to grow at 15% per year in 2026, the book value per share should be 350 rupees. Now, if it grows at 15%, and assuming that the price to book value actually decreases to 1.5 from around 1.97 right now, the share price we should expect is 525, which is not very exciting given that the current share price is around 430 rupees. So that would be a pretty bad result, right? And the interesting part is, even at a 15% growth, the company would give you a bad result, right? So that's one. Secondly, in the base case scenario, if it grows by 20% year on year, in 3 years, the book value per share should be 398 rupees. And assuming that the price to book value remains around 2, the share price which we can expect is 795 rupees. This is where you at least begin to see some returns, right? So this is at least way more favorable than the first case. But still, that requires a 20% compound growth year on year, right? And the bull case, if 25% year on year growth we're seeing at the end of 2026, the book value per share will be around 450 rupees. And if the terminal price to book value, meaning the price to book value at the end of 2026, is 2.5, because the company has grown at a 25%, 26%, usually there can be some re-rating in terms of the price to book value as well. That's when we end up with a very good result, right? If that plays out. Now the question really is that what is the likely scenario that will play out? And to be on the conservative side, I think, look, again, the company has the potential to grow at 25%, but as we discussed in the risk section, growth alone, especially for finance companies, is usually not a problem. It has to come along with managing the asset quality, and that's something that we need to monitor, right? Most likely somewhere between bare 15 to 20%. If the company can grow it, you can end up somewhere between these two results. So yeah, it really, I mean, there's no convincing, at least the book value per share method doesn't give you a very convincing case that the company is undervalued as of now. At least that is my opinion. I could be totally wrong. But that's how I'm seeing things as of now, right? The third type of valuation, which is super interesting, is sum of the parts valuation, where we're going to break down the different parts of IIFL Finance and then try to value individual parts, add those parts, and see what kind of valuation we're getting versus the market value of the company, right? So standalone IIFL Finance basically is the gold loan company, right? Gold loan and some of the other smaller pieces. And the book value for that is 4,800 crores. If we compare the price to book value of Muthoot, Manappuram, and we take an average of these two, it comes to 1.42, right? If we multiply 4828 with 1.42, right, because we're comparing with gold loan companies, our IFL standalone valuation comes to 6,855 crores, right? So that's part number one. The second part is all the other pieces except the gold loan piece, because the gold loans are basically come under the IIFL Finance, the standalone business, and the remaining pieces, home loan and microfinance, would be the remaining part, right? If you take the home loan, if we take the home loan segment, if we take the segment other than gold finance, the remaining book value is 3917. And like we discussed, there are two parts in this. One is the home loan section, and the other one is the microfinance section. So if you look at these three players, Awas, Aptus, and Home First, their price to book values are somewhere around this, and if you take the average, it's 4.1. If you look at some of the key respectable players such as Credit, Axis, Grameen, Arman, and Mass Financial, their price to book values are at these levels, and the average is 3.5. Now what I've done is I've taken a weighted average, because the price, the book value 3917, all of it does not belong to home loan side of things. A part of it is home loan, which is 75%, right, is coming from the home loan roughly, and 25% is coming from MFIs. So what I've done is I've taken a weighted average, and I've multiplied 75% weightage to 4.1 and 25% weightage to 3.5, and so we end up with a price to book value of 3.92, right? Even within this, on a conservative basis, let's say we value it at 3.5 to be on the safer conservative side. We end up with a valuation 13,709 crores, right? We add this plus 6,855, because again, that was part number one, this is part number two, we get to 20,565 rupees, right? Now this 20,565, if we compare with the current market cap, and I believe today is Friday, if we can actually check out, just one second. So I believe the market cap of IIFL Finance should be somewhere around 16,500 crores, 16,800. Let's just, right. So 16,800 crores is the current market cap, right? And if we compare 20,000 with that, we're roughly seeing a discount. The current market value is at a discount of 20%, right, according to our estimates. That is the more conservative estimate under the sum of the parts valuation. If we go with the valuation that we have calculated, which is 3.9%, 3917 into 3.9 becomes the 15,276 crores. right? And if we add 6,855 to this piece, 15,000, the total becomes 22,000, in which case the discount that we are currently getting, the market price is at a discount of around 25%. Now, frankly speaking, these are kind of like somewhat of a decent discount, but they are not really mind-blowing kind of opportunities where you would want to absolutely jump and invest immediately, because you need to leave some room, you need to leave a margin of error. And I think 20 to 30% is the bare minimum margin of error you sometimes want to leave, depending on how sure you are of the situation, right? Um, we could also add another piece to this, which is non-controlling interest, right? And that is currently valued at around 1,000 crores and 1,100,000 crores. And 1,000 crores, if we add in these calculations, will be roughly around 5%, right? Because 1,000 crores of 20,000 and 22,000, roughly around 5-7%. So, if you were to be add that in as well, you could say that your on the higher end, your discount could go up to 30%, and here it could go up to 25%. You can average that and you come up with, let's say, a 27% discount. So it's an reasonably adequate discount, but it is not like a crazy situation where it is deeply undervalued. It's somewhat reasonably undervalued. But I think the key learning from this situation would be that if you were to invest, for example, that I've invested in the company and I do have a very, very small part of my portfolio, what I want to do is I want to really monitor the situation quarter by quarter, how things are improving, so that if I see any signs of anything going wrong, I want to kind of eject and not lose money. So that's basically my thinking around valuation section. Hopefully this is somewhat insightful. If you have any questions, please leave them in the comment section below. And if you're still watching, please consider subscribing to our channel. It's a lot of hard work, a lot of fun, and it would be great if you were to become a subscriber. Thank you so much for watching.